Hello everyone, you're very welcome back to the channel. Today, we're answering the question, should you get a fixed, variable, or tracker mortgage when purchasing a home? Why does this decision matter? It matters because whatever you choose is going to determine your monthly mortgage repayment and the total cost of your mortgage. Seemingly small percentage differences between mortgage interest rates can result in large increases in total cost over the mortgage term. For example, a €360,000 mortgage taken out at a rate of 4% and repaid over 30 years would cost a home buyer €253,399.06 in interest. If the interest rate is increased from 4% to 4.5%, the total cost of the mortgage increases to €289,734.39. That's €36,335.33 worth of additional interest arising from a 0.5% increase in the mortgage interest rate. So, as a prospective home buyer and future homeowner, one of your principal objectives should be to not only secure the most favorable mortgage rate at the outset, but also to maintain the most favorable mortgage rate throughout the mortgage term. Achieving that objective requires an understanding of the factors which need to be considered when deciding between fixed, variable, and tracker rate mortgages. This video seeks to provide you with that understanding. Let's kick things off by explaining the differences between fixed, variable, and tracker mortgages. A fixed rate mortgage is one where the interest rate that's charged by the lender is fixed for a specified period of time. During this fixed period, your mortgage rate won't change. So you know with certainty what your monthly mortgage repayment is going to be each and every month until the end of the fixed rate period. A variable rate mortgage, on the other hand, is one where the interest rate that's charged by the lender can vary over time. So you might start off your mortgage at one rate, and over time that rate can increase or decrease at the lender's discretion. Unlike with fixed rate mortgages, a variable rate mortgage holder has no absolute certainty as to what their monthly mortgage repayment might amount to in the coming months or years. Tracker rate mortgages were introduced during the economic boom pre-global financial crisis and are no longer offered to borrowers. However, there are still some 244,000 households with tracker rate mortgages, and for those households, the question is whether to stick with the tracker mortgage or to switch to a fixed rate or variable rate mortgage. With tracker mortgages, your mortgage rate is guaranteed to not exceed the main refinancing rate as set by the European Central Bank plus an additional percentage, typically 1%. The direct linkage to ECB interest rates means that tracker rate mortgage holders are happy when ECB rates are low and not so happy when ECB rates are high. So let's talk about the factors that you need to consider when deciding between fixed and variable rate mortgages. The first of which is interest rates. And I don't mean the interest rate that is charged on your mortgage. I mean the interest rates that are set by the European Central Bank. Fixed, variable, and tracker mortgage rates alike are influenced by the three key ECB interest rates. When ECB rates are at rock bottom, like they were between 2016 and 2022, mortgage interest rates should, in theory, also be at their most attractive levels. Conversely, when ECB rates are high and rising like they are now, mortgage interest rates will also start to increase. The key consideration here is timing. Whether you're a first-time buyer, a mover, a switcher, or a buy-to-let investor, the timing of your mortgage agreement matters, and it matters because of interest rates. For example, the European Central Bank has increased interest rates on 6 separate occasions since July 2022 in order to tackle Eurozone inflation. In the Irish mortgage market, this has led to higher fixed and tracker mortgage rates and, to a lesser extent, variable mortgage rates. The question is whether or not you should lock in a fixed rate mortgage now at today's rates in anticipation of further ECB rate hikes in the future and consequently higher mortgage rates. Unfortunately, that's not a question that is easily answered. What the ECB decides to do with interest rates is predicated on future inflation data and the ECB's interpretation of that data. It's simply not possible for prospective or current homeowners to knowingly perfect the timing of their mortgage agreements so that they get the best financial outcomes. Therefore, it's more important that you're aware of the effects of timing and how good or bad timing may affect your financial situation. The different mortgage interest rates that are being offered by lenders is obviously a key consideration. Not only do you need to compare different rates offered by different lenders, but you also need to compare the differences between fixed and and variable rates offered by the same lender. When comparing mortgages, you should compare on the basis of the annual percentage rate of charge, or APRC, not the interest rate. Reason being, the way in which your lender calculates the interest on your mortgage can result in two otherwise identical mortgage interest rates, resulting in different monthly mortgage repayments. Lenders are required to advertise the APRC so that borrowers can accurately compare like with like. APRCs do have their limitations. For one, they are just estimations. APRCs on variable rate mortgages are calculated under the assumption that the current variable rate won't change for the full loan term. The longer the loan term, the more unrealistic this assumption becomes, and the more likely it is that your actual APRC will be higher or lower. APRCs on fixed rate mortgages are calculated under the assumption that the borrower will revert to the current variable rate offered by the lender at the end of the fixed rate term. This, of course, may or may not be true. Therefore, APRCs should primarily be used for comparability purposes at a single point in time, not as an accurate gauge of total mortgage cost. Fixed rates tend to be higher than variable rates. Reason being, you're paying a premium for the peace of mind that comes from knowing that your monthly mortgage repayment will not increase for the duration of the fixed rate term. Generally speaking, the longer the fixed rate term, the higher the fixed rate will be. Variable rates tend to be cheaper because you're taking on risk by affording the bank flexibility to change mortgage interest rates as needed. It's important to be aware that while fixed rate mortgages shelter you from the effects of rising rates, they also prevent you from benefiting from falling rates. So the premium you're paying for security won't be financially beneficial if variable rates don't increase, or worse yet, if they decrease during the fixed term. Likewise, if fixed rates for the same fixed period turn out to be cheaper in the future than they are today, then you will have suffered a financial loss due to bad timing. It's worthwhile mentioning that it is possible to obtain a split mortgage rate where one part of your mortgage is secured under a fixed rate and the other part is subject to a variable rate. You have the ability to choose what proportion of your mortgage is charged under each rate. By availing of a split mortgage rate, you can combine the peace of mind associated with a fixed rate with the flexibility that's offered by variable rates. Speaking of which, while fixed rate mortgages offer peace of mind, they offer little in the way of flexibility. If you want to break out of your fixed rate before the end of the fixed rate period, say to swap to a variable rate or even to a new lender, you might be charged a breakage fee by your existing lender. This fee is usually calculated using some variation of the formula shown on screen. However, lenders may differ slightly in their exact calculations. Whether or not there's a fee will depend on the movement of interest rates between the commencement of your fixed rate period and the date of breakage. This fee, where applicable, can be quite significant depending on the remaining mortgage balance, the remaining fixed rate term, and the movement of interest rates. So if you're subscribing to a fixed rate mortgage, it's best to be reasonably certain that you're going to stick with that rate for the duration of the fixed rate term. Of course, if on the basis of cost analysis it makes sense to incur this fee, or if there is no fee at all, then a breakage may be appropriate. However, it's important that this analysis is carried out before any decisions are made. Likewise, if you make overpayments to your fixed rate mortgage, you could be charged a fee by your lender. Some lenders allow overpayments to be made on fixed rate mortgages without any fee, i.e. a maximum monthly overpayment equal to 10% of your monthly mortgage repayment. Unlike fixed rate mortgages, a lender cannot legally charge an early repayment fee to a borrower who's on a variable rate mortgage. That means if you're on a variable rate, you can overpay as much as you like, and you're also free to switch rates and even lenders without fear of penalties. When choosing between fixed and variable rates, it's important to be aware that the size of the loan will influence your mortgage interest rate. Loan size is measured using the loan to value ratio, or LTV. So for example, if you wanted to borrow €360,000 to purchase a house that's valued at €400,000, your LTV ratio will be 90%. Your LTV will determine the LTV band that you're placed in, and your LTV band will determine the mortgage interest rate that you'll pay. A lender might offer a 3.5% variable rate to borrowers with LTVs greater than 80%. That same lender might also offer a 3.3% variable rate to borrowers with LTVs greater than 50% but lower than 80%. The higher your LTV, the higher your mortgage interest rate will be. The relationship between high LTVs and high mortgage interest rates reflects the fact that high LTV mortgages are riskier for lenders than low LTV mortgages. An LTV of 90% rate would mean that the property could decline in value by 10% and the lender would still be able to recoup the full value of the loan if the borrower defaulted on his or her obligations. However, with an LTV of 60%, the property could decline in value by 40% and the lender would still get all of their money back. Clearly, the lender would much rather have 40% worth of leeway than 10%, hence why lenders reward lower LTVs with lower rates. While you might start off your mortgage in one LTV band, you can move to a lower band as your LTV ratio starts to decline. Your LTV ratio will decline if either A, the property valuation remains constant as you gradually pay off your mortgage, B, the property valuation increases by a sufficient percentage to move you to a lower LTV band, or C, the combination of both mortgage payments and a higher property valuation moves you to a lower LTV band. House prices have increased significantly since 2020, so it's quite likely that pre-2020 mortgage holders could qualify for a lower LTV band and potentially a lower mortgage interest rate. In order to apply for a lower LTV band, you need to provide the lender with an updated valuation report for your property. Whether you're classified as a first-time buyer, a second or subsequent buyer, or a buy-to-let investor can also influence the mortgage interest rate that you pay. Likewise, the energy efficiency of your home may also grant you a lower rate. Certain lenders offer reduced introductory rates and other incentives like cashback to first-time buyers and new business, all of which needs to be considered when weighing up your options. Your buyer classification also determines how much of a loan you can take on. For example, in Ireland, first-time buyers and second and subsequent buyers can have a maximum LTV ratio of 90%, meaning they need to have a 10% deposit. Buy-to-let investors can have a maximum LTV ratio of 70%, meaning they need to have a 30% deposit. On top of this, first-time buyers can take on a maximum mortgage equal to 4 times gross income. For second and subsequent buyers, this is 3.5 times gross income. So for example, a first-time buyer couple with a combined income of €100,000 can borrow up to a maximum of 400 grand. However, the central bank permits lenders to breach these limits by a certain amount. 15% of first-time buyer lending and second and subsequent buyer lending and 10% of buy-to-let lending can take place above the limits. Obtaining a larger than normal mortgage is referred to as getting an exception or exemption. Lenders also carry out their own tests to ensure that you can afford the mortgage that you're taking on. These tests include stress tests, i.e. assessing your repayment capacity if rates were to increase by, say, 2%, and a net disposable income test, i.e. assessing how much income you'd have left over after mortgage payments have been made. If a borrower is failing to meet the net disposable income test, one potential solution will be to borrow over a longer mortgage term. This would have the effect of reducing the monthly mortgage repayment, but would also significantly increase the total cost of the mortgage. So with all of that being said, should you get a fixed, variable, or tracker rate mortgage? Unfortunately, the answer to that question is the answer that nobody wants to hear. It depends. Mortgages, just like investment decisions, need to be considered in the context of your own personal circumstances as an individual. We've outlined the various factors that need to be considered: ECB interest rates, mortgage rates offered by different lenders, the flexibility and inflexibility of both variable and fixed rates respectively, loan to value ratios, and your status as a buyer. On top of all of that, you have your own personal circumstances that will feed into your mortgage decision. In my opinion, interest rate hikes will continue until the end of 2023 and potentially into 2024. For tracker rate mortgage holders, this would be objectively bad news, as their mortgage interest rates have already increased from 1% to 4.5% in the space of 9 months. That will continue to worsen with future rate hikes. However, we don't know where rates will be in a few years' time. If those on a tracker rate were to swap to a fixed or a variable rate, they would lose their tracker rate for good. And if the ECB were to lower rates significantly, which could very well happen when inflation normalizes, that would represent a missed opportunity. My view would be that if the monthly cost of the tracker rate does not materially differ from the fixed or variable rate that could be obtained, then it's best to keep the tracker. If ECB rates continue to rise, so too will fixed mortgage rates. So if you need to get a mortgage now and you want the certainty of fixed rates, then it could be ideal to fix now for a short period of time, say 2 or 3 years, just to see what happens with interest rates and inflation. After the fixed rate period, you can reassess your options. I personally wouldn't be opting for long-term fixed rates because there's just too much uncertainty uncertainty around what the ECB stance on monetary policy will look like going forward. Even though fixed rates are becoming more and more popular, there's still a lot to be said for variable rates. Flexibility being the main attraction, but if rates do end up working in your favor and you're happy to take on the additional risk, then you can end up with a significantly cheaper mortgage. But let me know, which mortgage do you think is best? Fixed, variable, or tracker? What type of mortgage do you currently have, and are you considering a change in the future? Have you got any tips or advice of your own for prospective homeowners? Leave it as a comment down below. If you found this video to be useful, can I ask that you take just 2 seconds out of your day to show your support by leaving a like on the video, subscribing to the channel, and sharing with family and friends. Before you go, you might be interested in this next video, which talks about whether or not you should buy a house in Ireland now or wait until next year. Thanks very much for watching, and I'll see you soon.